billion exit. If you've spent any time on YouTube today, your feed is likely flooded with red thumbnails and panic. Bitcoin has officially slid down, breaking through the psychological $70,000 floor. The noise is hysterical, pointing blame at escalating geopolitical friction and hotter inflation data. But the signal is far more systemic and is hiding in the institutional plumbing. Spot Bitcoin ETFs just logged a record-breaking 10-day streak of consecutive redemptions, flushing an unprecedented $2.97 billion out of the digital asset complex. Where is that massive wave of institutional liquidity actually migrating? It's chasing the raw, high-velocity AI infrastructure trade that is printing all-time highs across traditional markets. Today, we look past the retail fear to dissect the reality of Wall Street's great capital migration. Welcome back to the Signal and Noise podcast. My name is Newell. Let's dive in. Let's lay down the foundational data points. For months, the market narrative was simple. Institutional inflows into spot ETFs were a one-way street that would inevitably push Bitcoin into six figures. But as we've warned on this channel, institutional rails are a double-edged sword. The record redemptions. Over the last 2 weeks, US spot ETFs have faced an absolute hammering. BlackRock's iShares Bitcoin Trust alone has absorbed the brunt of this shock, accounting for over $2 billion of those total outflows since mid-May. The magnification effect. This is the structural reality the market forgot. ETF issuers are mechanically forced to liquidate physical Bitcoin on the spot market to back share redemptions. The exact same vehicle that accelerated the run past $80,000 earlier this year is now systematically amplifying the downward pressure on the asset. The leverage washout. It's not just institutional spot selling. As Bitcoin dropped down to around $69,000, it triggered a cascading $352 million liquidation wave across leveraged derivatives markets, pulling major Layer 1 networks down with it. So why are these asset managers pulling the plug all at once? It's not because they suddenly decided blockchain technology is a fad. It's a tactical, cold-blooded capital reallocation. Wall Street is aggressively chasing the AI and high-performance computing trade, which has taken over the S&P 500. The yield and opportunity cost. With U.S. Treasury yields remaining stubbornly elevated, the risk-free rate of return is incredibly high. If you are a traditional fund manager, parking capital in volatile digital assets looks a lot less attractive when you can capture predictable yields or ride the explosive revenue growth of physical AI data centers. The structural divergence. We are witnessing a historic divergence. Historically, Bitcoin traded hand-in-hand as a high-beta proxy for big tech and software stocks. But right now, equity indices are pushing into all-time highs, while Bitcoin is actively decoupling and sliding backward. The last two instances. On-chain data indicates that this exact kind of decoupling has only happened twice before in modern crypto history. In both previous instances, when Bitcoin completely broke away from software equities, it signaled an absolute exhaustion of seller liquidity before staging an aggressive, vertical trend reversal. This brings us to the ultimate contrarian variable, retail sentiment. According to analytics data from Sentiment, crowd sentiment on social media has flipped into its most intensely bearish territory of the year. The FUD spark. Compounding the panic. Headlines flash that corporate giant Strategy sold a minuscule 32 BTC for $2.5 million to optimize its internal cash flows. It was their first sale in 4 years, and retail immediately digested it as a catastrophic warning sign, entirely missing the fact that the company simultaneously retired $1.5 billion in debt to aggressively eliminate shareholder dilution. The crowded short. When retail sentiment gets this overwhelmingly negative and people start shorting the asset in size, it historically builds the exact dry powder required for a violent short squeeze. The market structure isn't broken, it's being cleared of weak hands. So what's the verdict? The signal. Stop panicking over 10 days of ETF redemptions. This isn't a permanent rejection of Bitcoin. It's a textbook, quarter-end portfolio rebalancing by institutional players moving capital into hyper-growth AI narratives. The move. Keep your eyes firmly fixed on the stabilization of BlackRock's capital flows. The moment those massive outflows flatline, the spot market selling pressure vanishes. With retail completely washed out and sentiment at rock bottom, the stage is quietly setting for a structural bounce. Wall Street is playing a high-stakes chess game with liquidity, and right now they want you to sell them your bags. Stay sharp, stay focused. That's it for this emergency edition of Signal and Noise. When the chart screams red, look for the structural signal. My name is Newell. Like and subscribe. We'll see you in the next one.